May 2021. After 15 months of lockdown and nearly 600,000 deaths, the United States looks to be headed back to pre-pandemic life. But some things have changed forever. One of those is the American dream of owning a house. Since bouncing back from the unprecedented lows in 2012, the price of a single-family home in the United States has followed a steady line all the way up until 2020. The visualization is clear, and where this line is headed to doesn't look great, as home prices have surged and are showing no signs of slowing down. In April 2021, the typical value of a single-family house stands at $339,000, up from $275,000 in mid-2019. This change has priced many, mostly millennials, out of the market and caused serious frustrations to new families looking to start their lives as their parents had in the generation before. The big question everyone has is what is going on. The typical answer that we've been hearing is that inventory is the problem. Various housing CEOs have come on CNBC and explained their case for the pricing pain many buyers are feeling, but new data is coming out to suggest that inventory isn't actually the cause. RedFin CEO Glenn Kelman has been very public about the underlying issues in the market, despite the fact that he likely stands to profit from these price appreciations. He took to Twitter to vent just how bizarre the US housing market has become, laying out 15 points to consider. We've all heard some of these before. Tweet number 2 as an example. There are now more realtors than listings, which suggests there is indeed a shortage. Tweet number 3 confirms that with some statistics that outline the fact that inventories are down 36% year over year. But tweet number 4 is the one we need to focus on. While many quickly point their fingers at inventory shortages as the main reason for these price appreciations, this stat puts that into serious doubt. In New York and San Francisco, two of America's largest cities, inventories have increased, 22% in New York and a whopping 77% in San Francisco. And still, in both markets, prices are increasing significantly. Let's focus on San Francisco for a second, the city that everyone was supposedly running away from. A city that's had the biggest increase or the largest increase in inventory year over year since 2008. That city still has elevated housing prices. This does not give the rest of us much hope even if new houses are being built en masse. One study found that in 2020, net exits from San Francisco increased 649% compared to 2019. These are massive numbers, yet the real estate market isn't budging. This is especially true in low tax state, where for one person who moves and leaves, 4 people move in. For Florida, this ratio is 7 to 1. Californians who are strapped with cash are pushing some cities around with massive offers. The average housing budget for an out-of-towner moving to Nashville was $720,000. That's 50% higher than the locals' $485,000 budget. So the big question is, how do we make home prices healthy again? And what is a healthy price really? Well, one of the best ways, in my opinion, to look at just how overpriced things are is to stare at this chart. The S&P 500 versus the Case-Shiller Home Price Index. That may sound like a mouthful, but this chart gives you a grasp of just how bad it is out there. The red line represents the S&P 500, while the black represents the Case-Shiller Home Index, a measure of housing prices. After the 2000 crash, or the 2007 crash, you can see that the stock market and the housing market were essentially equal. But since home prices have been relatively calm compared to the extreme returns we've been seeing in the S&P, this in 2020 is no longer the case. While normal, lower, and middle-class Americans have little interest or even benefit from the S&P 500 skyrocketing like this, it's also true that this massive spike in stock prices has made a lot of people a lot of money. Money that is now flowing into real estate, in my opinion, and housing is only now beginning to catch up with stock returns. Based on this chart, we're only getting started, but if you take a listen to any of the big so-called experts that work for these giant real estate companies, you'd be convinced that the market is elevated, but not concerning. They always offer a wide range of reasons why this pricing environment is the way it is. Take a listen to Zillow President Susan Daimler on CNBC last week.
Are you getting concerned that pricing is getting a bit too frothy?
Yeah, great to be here. Thanks for having me back. We are not concerned. So a few things. One, the housing market has just been this, I think, incredible bright spot during the pandemic. And we believe that vibrancy is going to continue. And despite what we're hearing today about home sales, there are a couple things we need to remember that are really important. So one is we are still at record pace here for home sales. And we are on track to beat home sale volume from 2020, which was at a 15-year high. And then in addition, back to the supply and demand piece, we're starting to see these signals of inventory listings creeping back on, which could signal this rebalancing of supply and demand, which would be welcomed.
So what is the outlook on the supply side? Do you think it can catch up in the short term, or are we quite a long way off that happening?
Yeah, I think it will take some time, but I think we're starting to see those signals, and that buyer demand is still really persistent. We're seeing this great reshuffling, as we call it. People are on the move. They have reasons they need to move. They want to move. They have to move. And so with that compounded by these millennials who are really just getting into their home buying time, we're going to see it keep going, and that balance keeps shifting.
With such a rapid rise in price over the past dozen months, this feeding frenzy is fueling itself into an upward spiral. The longer prices shoot up, the more people are inclined to go and purchase today, because the perception of higher prices in the future will fuel their decisions to buy quickly. It's no wonder that a RedFin survey of nearly 2,000 homebuyers revealed that 63% reported having bid on a home they hadn't even seen yet in person. Where this ends, nobody really knows, but I have a sneaking suspicion that this is heavily related with this, which is now finally leading to this. While many have tried to come up with complex ways of explaining why these housing issues are starting to unfold, I have a simple answer that is often dismissed by many in the CNBC professional finance media crowd. Inflation. I guarantee you inflation will be the number one topic for the next year and will undoubtedly reshape everything we know about the economy as a whole, including real estate. Thank you guys for watching, and as always, smash that subscribe button if you want to enjoy more content like this. Oh, and before we end, consider signing up for BlockFi using my affiliate link down below. Sign up with BlockFi, and for a limited time, you can earn a crypto bonus of up to $250 when you open up a new account.